Welcome to the Efficient Private Clients Quarterly Update. Today we are joined by Etienne Viljoen, our Chief Investment Officer, as we discuss the first quarter for 2023. After the gains that we saw at the end of the last quarter for 2022, where do we now find ourselves at the end of the first quarter for 2023?
Well, that momentum continued throughout the world, especially in Europe, where we saw double-digit gains, helped by falling energy prices. In the US, the tech-heavy Nasdaq also advanced by more than 15% after a terrible 2022. The S&P and MSCI World both gained about 7%, and locally we lagged a bit and ended up only 4%, mainly supported by the gains in Naspers after the Chinese reopening.
Global inflation has been at an all-time high, and we saw it easing in the last quarter. Is this still the main concern for market sentiment?
Yes, well, inflation and interest rates are still the words on everyone's lips. I think it's not a question of whether inflation has peaked, it's just a question of how far and how quickly it will come down. Thus far it remains sticky. The tight labour market is the biggest concern for the Fed. They will probably have to push rates up to a point where the economy will be in some sort of a recession. We've steadily been seeing job losses growing from the tech sector, but we will have to see other sectors also coming to the party to get inflation down. On the positive side, shelter inflation have been showing signs of slowing.
Locally, we've had our own set of challenges. How does this affect the markets and the performance of the rand?
Well, the energy crisis definitely reached a new level of severity, and the government's lack of willingness for policy reform also isn't sitting well with foreign investors. All of that resulted in a 5% drop in value for the rand over the quarter. It must however be mentioned that we do believe the rand can strengthen throughout the rest of the year, as it should benefit from the Chinese reopening and overall positive market sentiment towards emerging markets.
Banks have had a lot of media attention of late. Do we see this becoming a full-blown crisis?
I don't believe so. Silicon Valley Bank and Credit Suisse had very specific reasons for failing. Silicon Valley Bank being very exposed to tech entrepreneurs in one specific sector. As we already mentioned, rising interest rates bring a lot of pressure on those tech startup firms. Credit Suisse having a history of bad management and scandals, so they were basically on the brink. So this tightening monetary policy just put extra pressure on these two that was already in distress. I don't believe these two are representative of the overall banking industry. After 2008, I believe the balance sheets are looking much better and most banks are very well capitalized.
Where do we find our strategic positioning for the next quarter?
Well, we use some of the recent rallies to realize some profits, especially in the tech, energy and real estate sectors. Going forward, we see a lot of volatility and uncertainty. Definitely pockets of value, but not everything and all sectors doing well. Emerging markets should be a big contributor to returns going forward. And then also policy normalization should make stock picking much more important. I think we've become used to QE pushing all stocks up. When the tide goes up, all stocks go up. That time, I think, have passed, and emphasis should definitely be put on profitable companies with a good track record, and active management is definitely going to be much more important.